The decision regarding how to hold commercial property, whether in personal names, through corporate entities, or via partnership structures, carries significant legal and financial implications that every serious investor must carefully consider. Personal ownership remains the simplest approach, requiring minimal setup and administration while providing direct control over the asset. However, this straightforward method comes with substantial risks, including unlimited personal liability for property-related debts and legal claims. From a taxation perspective, personally held commercial properties report income directly on the owner's individual tax return, potentially pushing them into higher tax brackets while offering limited opportunities for tax planning or income splitting. The lack of asset protection makes this approach increasingly unsuitable as property values and associated risks grow. Corporate ownership structures, particularly through limited liability companies or corporations, have become the gold standard for commercial property investors seeking both protection and tax efficiency. These entities create a legal separation between personal and business assets, shielding owners from personal liability for property-related obligations. The tax treatment varies significantly between corporate forms. Traditional corporations may face double taxation, but benefit from lower corporate tax rates on retained earnings, while flow-through entities like LLCs avoid corporate taxation while providing flexibility in income allocation. Corporate structures also enable more sophisticated estate planning strategies and facilitate easier transfer of ownership interests. The additional administrative requirements and compliance costs represent the primary trade-off for these benefits, though they are often justified by the substantial advantages for serious commercial investors. Partnership arrangements offer unique advantages for joint commercial property ventures, combining elements of both personal and corporate ownership. General partnerships maintain simplicity but expose all partners to unlimited liability, while limited partnerships allow passive investors to participate while limiting their exposure. The tax treatment flows through to partners' individual returns, avoiding corporate taxation while permitting flexible allocation of income and deductions. Modern limited liability partnerships have emerged as particularly attractive options, combining the tax benefits of traditional partnerships with enhanced liability protections. These structures require carefully drafted partnership agreements to address management responsibilities, profit distribution, dispute resolution mechanisms, and exit strategies, all crucial considerations for commercial property ventures where significant capital is at stake. The optimal ownership structure for commercial property depends on multiple factors, including investment scale, risk profile, tax situation, and long-term business objectives. Many sophisticated investors employ hybrid approaches, using different structures for various properties within their portfolios to optimize both protection and tax efficiency. Recent legal developments and tax reforms in many jurisdictions have made corporate and partnership structures increasingly attractive for commercial holdings, though the specific advantages vary by location and individual circumstances. Regardless of the chosen approach, commercial property buyers should engage qualified legal and tax advisors early in the acquisition process to ensure their ownership structure aligns with both immediate needs and future growth plans while complying with all regulatory requirements. The right structure not only provides protection and tax benefits, but also creates a solid foundation for portfolio expansion and wealth preservation.